If you're interested in a whole life insurance policy and cash value is your goal, what company should you choose? I would recommend always starting with one of the four major mutual companies, which are MassMutual, Guardian, New York Life, and Northwestern Mutual. Now, when I say I recommend starting with one of those four, what I mean is I recommend that you at least consider one of those companies, if not all of them. Usually, we'll consider at least two of those companies. Our company personally works a lot with MassMutual and Guardian, but I always recommend at least considering one of the four major mutual companies. And the main reason why is because we've seen proof of performance. So when you look at whole life insurance, and particularly the cash value, if one's interested in a whole life insurance policy and they express, I want the highest cash value possible, that's why I am interested in this product. A big source of buyer's remorse that occurs in the life insurance industry is that one purchases a policy, they look at an illustration, it tells them they're going to have $1 million 20 years from now, or whenever it is, and then when we hit 20 years later, we've only got $600,000. So I thought I was going to have $1 million, but I only have $600,000. Is that going to leave a good taste in your mouth with whole life insurance? No, it is a big reason why the industry has a bad reputation. So what we've seen to work, meaning satisfied policyholders with policies that have produced strong actual cash values, are whole life insurance policies with one of the four major mutual companies, assuming that that product is designed for high cash value. What I mean when I say that is that the insurance expenses are minimized as low as the life insurance company will allow. Commissions are reduced as low as possible. When you combined designing that policy appropriately with minimum expenses and one of the four major mutual companies, that is where we've seen strong proof of performance, meaning strong actual policies. So I would always start with one of the four major mutual companies and I'd also make sure it's designed appropriately. We've got MassMutual and Guardian here. We use them heavily in our practice, and a big reason why is one, because of the proof of performance, we've seen the quality to be there, and then two, they're very flexible. So with both of these companies, we can set up a whole life insurance policy where someone wants to pay in $10,000 per year. Now, when setting up the policy appropriately, going to the design piece, of that $10,000, a lot of people aren't aware of this piece I'm about to mention, you, the policyholder, can actually choose where your money goes. So of that $10,000, you can choose to direct it toward the premium or toward this PUA rider. PUA stands for paid up additions. Here's how the two areas work. Premium dollars often purchase you a death benefit first. So if I put the full $10,000 into the premium, I may see zero show up in cash value in the first year. It might even be the first and second year. So I'm making this $10,000 payment and I've got nothing to show for it. Now, premium dollars will eventually show up in cash value. So call it by year 3, I make that $10,000 premium payment and I see it come back to my cash value. So it does build cash value as time passes. However, whatever that premium is, with a traditional whole life insurance product, it typically does not show up in cash value in the first year and sometimes the first and second year. A big reason why is because the insurance company is overcharging us for the cost of insurance, the death benefit up front. The PUA rider, I like to refer to as a cash dump-in, because if I paid, let's say, that full $10,000 into the PUA component, I would see almost that full $10,000 show up immediately. Companies do have PUA fees. I might see on day one, if I pay $10,000, anywhere between 90 and 95% show up in cash value immediately. However, this does begin to compound for me. This will accelerate the growth of the policy. This is really the key to accelerating the cash value growth of a life insurance policy. So a question that we used to receive a lot, I received it when I was relatively new to life insurance and trying to understand all of this. My father actually asked me this many years ago. He said, "Can I put nothing here and just put it all into the PUA rider?" And the answer was no, you cannot do that, unfortunately. And the reason why is because different insurance companies have limits as far as how low the premium can be or how much more you can add in PUAs on top of your premium. What you'll find with the major mutual companies is that we can often pay whatever our base premium is, an additional 10 times that in PUAs on a yearly basis. Now, there are some exceptions to that. The policy does need to be designed appropriately to do that, meaning I could take a policy where if I set it up right, I can pay 10 times my base premium in PUAs, which will maximize your cash value. If I don't set it up right, I might only be able to pay 3 times my base premium in PUAs. So there's a lot of rules that are tied to life insurance companies, and having awareness of those rules is very important to ensure the highest level of success when my goal is maximizing the cash value. But with these two companies, they can be set up in a similar manner where if again, I'm paying that $10,000 amount, I can set this premium at how low? If I can pay 10x my premium in PUAs, well, to simplify, if I've got a $10,000 payment, I can set my premium at $1,000 and pour the rest into PUAs. That is a great way to maximize the cash value. We like to refer to that as a 10-90 split, meaning a 10% base premium, 90% PUA, or as aggressive as the life insurance company will allow. Now, there are other differences, which we will hit on in a minute. Some questions here. To answer the question, what company should I choose? Let's assume you want to pay $10,000 per year. Question I would have is, do you want to commit to $10,000? Meaning, do you want to add more than that? Or do you want to get billed for $10K every year? Or would you prefer to be billed for a lower amount? Or do you just want to set it and forget it? To give some examples here, let's assume you pick a policy with Guardian. Guardian will allow you to commit to a minimal amount, let's call it $1,000 per year, approximately, and then 100% at your leisure, you can add up to an additional $9,000. So what that means is that you're billed for the $1,000, whether that's paid yearly or you pay it over 12 months, and then everything else can be added at your leisure. How you do that is by sending in a check, your online portal through a laptop. Maybe it's your mobile app, a wire transfer. It's very, very flexible when it comes to adding money to the policy. Now, Guardian works well if someone likes this type of flexibility. They want to pay in $10,000 per year, but they don't want to fund it longer than, call it 10 years, not at this level. After 10 years, they say, I either want to stop or I want to continue to add money, but the most I'm going to add might just be the premium. I'm going to take my foot off the gas a bit. We often see this if someone's looking to pay in $100,000 or several $100,000 per year, where they want the ability to really aggressively fund the policy for a short period of time, 10 years or less, and then stop or pay just a reduced amount. We see that quite a bit. But Guardian is great with that type of flexibility where I can commit to a minimal amount and add more money at discretion. Now, if I wanted to set it and forget it, say, hey, 10K per year, this is what I want to do. I've got everything budgeted. I still want it set up where I have a minimum premium of $1,000 per year. I want $9,000 to go toward my PUAs, but I don't really need that flexibility. Like, I just want to force myself to save $10,000 per year, and I want to fund this life insurance policy for the cash value benefit. I like the death benefit too. Set it and forget it. Well, in that case, I would go with MassMutual. And a big reason why is because an advantage to MassMutual products, I can design them like this. and I could just keep on funding. Maybe it's 30 years, maybe it's a long period of time. I can set it up with this 10% premium and continue to funnel money into the policy. Now, if life happens and I can't make that $10,000 payment, well, I can easily reduce it to as low as the $1,000 per year amount. And if I funded the policy for a couple of years, I could even pay in zero, similar to what we could do with a Guardian policy. After I fund for 10 years, I could stop altogether. You could stop earlier than that too. But Mass works well if I'm not in need or don't really care about that flexibility where I can add funds at leisure. I'm comfortable with a one-time per year payment. I still want to maximize the cash value, but just making a one-time payment every year is what I want to do. And I can adjust the total amount. With Mass, we talk about this in some of our other content. I might pay in $10K the first year, then $8K the second year, then $3K, then back up to $10K. I can adjust the total amount I pay with a MassMutual policy. The item to be aware of is that I can only do it one time per year. I should say, I can do it one time per year in a very convenient manner if we set that policy up correctly. Some other questions that come up. We skipped over this one. Do I want to add more to the policy? What if you said, I want to start with $10,000 per year, but I'd like to be able to add up to $50K per year? Well, what we would do then, if that's the most you ever want to pay, we would set it up like this, where your premium would be $5,000. That's $5,000 per year. If you wanted to schedule a $10,000 per year payment, what we would do is schedule another $5,000 to go into PUAs, but then set it up where you can add additional PUAs of another $40,000. So I can pay PUAs the same time as my premium and then have the option to add more on top of it. This is referred to often as an unscheduled PUA payment, meaning I'm throwing it in on an unscheduled basis. I might do it, I might not. It's completely up to me. And again, the company selection is important here, and this is where we would help one select the company they feel is best. So if I went with Guardian, what I could do here is commit to the 10. It could even be closer to just the 5, but if I wanted to commit to 10, I could do that, and then add additional funds, the additional 40, at leisure over the course of the year. If it was with MassMutual, then what I would do is commit to the 10, and then every year on my premium due date, if I wanted to increase it, I would do just that. So we'll assume you pay $10K in the first year, second year, you have a good year, and you say, I want to fund $30,000 this year, then you could do exactly that. We would just increase the total funding amount to $30,000 for policy year 2. So you can add more. This is something we do need to design the product to accommodate upfront. Very important to do that in the beginning. One of my favorite questions to ask here is how much does one want the ability to add into a policy on any given year? Meaning, what's your high-end dollar amount? Because if you say $50,000, and I know we can 10x the base premium in PUA payments every year, that's the maximum the company will allow, I'm going to set the policy up with a premium that can handle $50K per year. I'm going to set the policy up with a MEC limit of at least $50,000. A MEC limit is a taxable limit on a policy. It stands for Modified Endowment Contract. But having that number up front, we're saying, here's how much I want the ability to add to the policy, really helps me set it up correctly, or helps your agent set it up correctly. Do you want to start with a lump sum? This is common. Maybe someone wants to pay $10K per year, but start with a $100,000 lump sum. In a case like this, based on the rules of these two carriers, we would look at both, but I would probably gravitate toward Guardian. And the reason why is they've got a nice rule in policy year 1, which is they allow 50 times the base premium to be added in a PUA payment. Now, it does not always make sense to go up that high. You'll find we have to add a lot of death benefit to the policy through a term rider and such. But my point is, we can add a large lump sum to the policy higher than what MassMutual might allow. If I wanted to start off with $100,000 with a MassMutual policy, my minimum premium is going to be $10,000. Whereas if I wanted to start off with $100,000 with a Guardian policy, I could get that minimum premium as low as $2,000, depending on how much I wanted to pay afterwards. In cases like this, it often ranges somewhere between $3,000 and $5,000. But my point is, we can commit to a much, much lower amount while still being able to add a large lump sum, which really accelerates the cash value growth, which is very exciting when you see it grow at a fast pace right out of the gates. And then here, how long do I want to pay into the policy? Do I just want to fund 1 year, 5 years, 10 years, 20, 30, forever? Or I don't know. Sometimes the answer is I don't know. In a case like that, I might show a couple different options that really optimize the sweet spot with different companies and products. For example, if I said I might want to be able to pay into it for a long period of time, MassMutual's product does accommodate that. I may look at their high early cash value product, which gives me high cash value up front. The long-term performance is still attractive, and I can pay into it until I'm 85 years old. So I can fund it for a long period of time. If I said, well, I don't have to fund it forever, I don't really want to do that, but I'm not sure how long, well, I'll ask. Age 65? How about 15 years? Could you see yourself wanting to fund longer than 15 years? Do you like the idea of funding it for 5 years and stopping altogether? Would you like to see a couple different options? Maybe we look at one product and show you what it looks like if you paid into it for 5 years, 10 years, or 15 years, if you think 15 is the cutoff. This way you can see that same product and what it looks like if you pay into it for 5, 10, or 15. But when you start, you don't have to pick one. So you can plan to go for 15 and then stop at 5, maybe it's 10, maybe it's 7. You can adjust as you go. So if it's set up to be very flexible, now you don't feel like the policy is a burden or anything like that. So how will help someone select the right company? The first part's simple, quality carriers. We like life insurance carriers that have displayed strong proof of performance. But then number 2 really has to do with flexibility and just not getting into a policy where you find out after the fact you can't do something that you want to do. Like that's what we want to avoid, which is why having an understanding of the rules of the game, different insurance companies and products, is very, very helpful, regardless of who you're working with. If you're speaking with an agent that works directly for a life insurance company, they likely know this information or they can get it from that company. We just sometimes need to know the right questions to ask and such. But I would ask about the flexibility features, but ask yourself that too. Like, how do I want to fund the policy? If it's set it and forget it, that's easy. Just make sure the policy is set up with a minimum premium because that will maximize your cash value. If you want to be very creative and commit to a minimal amount and then add more money at your discretion, ask if you can do that because not all companies allow it. So it's beneficial to have that knowledge or know the right questions to ask so we don't find something out after the fact and then we've started the policy and we're somewhat stuck in it. Yes, there's ways to exit, but it is not always efficient. We could end up losing some money. If we get it right from the get-go, we're much, much better off. So I do hope that this helped. Let us know if you have any questions at all, and I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.